Hey, dealmakers, welcome to the show where it's all about financial freedom with real estate. Let's do this. So back in the day, when I was flipping houses, I flipped 3 dozen houses in about 3 years, and it was super cool. I felt like I was kind of the king of the real estate investing. I mean, it's a lot, right? Most people can handle maybe one flip at a time, 6 months each, right? So you're making $50,000 per, so you're making 100 grand a year, which is super cool. But then my biggest frustration was, first of all, two things. One is it was a lot of work, because if you're not buying, fixing and selling houses, then you're not making money. And then worse, when you do sell it, of course, you stop making money. It's not really passive income. And the other reason it's not passive income is it's a lot of work. I mean, it took a lot, even though I had general contractors and brokers, it was still a lot of work. You're constantly solving problems and things of that nature. And it wasn't really cash flow. It's not really what Robert Kiyosaki talks about in his book, Rich Dad, Poor Dad. And I didn't get this until like literally 3 dozen flips. I don't know what my problem was. And maybe you can relate, right? And then I thought, well, let's work smarter, not harder. And let's just build up a rental portfolio. Surely that will give me passive income. But I did some math. And the math was that, let's say you can get each property cash flow, let's say $200 a month, which is a lot. And by the way, when a tenant moves out and you got to put a bunch of repairs in, that entire profit for the year might be gone, or the AC breaks or something. So it wasn't a lot, but let's say you could. And I wanted $10,000 in passive income. I would need 50 rental houses. And I just spent 3 years basically flipping 3 dozen. It would take me 5 years to buy and hold, and it would be an unbelievable amount of work. As you can imagine, you'd have to not only do the transactions, that's a lot of work, but then you have to actually finance it, which is a problem because it's very difficult to finance 50 houses. And then you'd have to manage it, right? And I knew from others in the business that, it wasn't really common to have a really good experience with a professional property manager. Typically, it is a part-time realtor that, manages properties on the side. And so the results were very hit or miss. And so my biggest frustration in my early days was my inability to scale real estate. And I just really felt like real estate investing was broken. And I didn't really know a way out until I discovered it a bit by accident. And today, obviously, we're in the multifamily space and we have $300 million in a portfolio, and everything kind of changed. And what I want to talk about in this episode is why did it change exactly? And then a little bit how as well, but mostly why, because there's a lot of you maybe listening, watching this right now that are a little bit like me. And you really believe that your path of financial freedom is flipping houses or rentals or short-term rentals or following the BRRRR method. And I want to talk about on this episode why it's not likely to get you to your goal. So I came to the solution a bit by accident. When I first got in my apartment building, it was in 2011, and I got it from one of my wholesalers that I was buying flips from. It was a 12 unit in Washington, D.C., and I had known about apartments because I quit my job in 2005. So in the next 2 years, I just took all these seminars. I traded stocks and options, and I took a commercial real estate investing seminar, which was super cool. So I knew about apartments, but yet somehow I got into flipping more in 2009 and did not get into apartments for a bunch of reasons, which we'll talk maybe another episode of what are the things that have held me back mentally, like from a mindset perspective, and what I see a lot of people being held back. But for me, let's talk about the solution of why multifamily seem to have solved these problems. Well, first of all, it created a lot of problems for me. And what happened is I bought this 12 unit in Washington, D.C. And my fundamental problem, if I were to boil it down, is that I did it or tried to do it on my own. And because of that, I had a variety of very large mistakes that compounded. Problem number one is I bought in Washington, D.C. Now, what this means is that the laws in Washington, D.C. are very pro-tenant. They're very similar to California, New York, Oregon, and they're really there to protect the tenant. And I understand that. The problem is it makes it very difficult to do business in the district. And I had one of these professional tenants in there who knew about all these laws, and he basically took advantage of them. I mean, obviously he was within the law, but it made it very difficult to do business. And not only was he not paying rent, that was bad enough. The problem is because of the laws, it was very difficult / impossible to get him out. So it made it easy for him not to pay the rent. That's not really the intent. And it's not really the intent, obviously, of a tenant-landlord relationship. But then also, it made it difficult to do business because he sued me every 6 weeks about the same 12 made-up things. And I had to go to court and pay attorney's fees. And finally, after like the 4th lawsuit, I was in court. This whole thing was kind of like the judge kind of took me aside. Oh, dude, what's going on over there? And she knew that these are all BS stories, but there's nevertheless complaints, and you have to do diligence on them. And then the third problem was, and by the way, a mentor or someone advisor, first of all, would have advised me not to invest in the district, number one. Number two, go through the legal history of each tenant, because this was a Section 8 type building. And that led me to the third problem. I had the wrong property manager in there, and that property manager did not know how to deal with Section 8 tenants, didn't really need to know a deal with the housing authority and inspections, and therefore simply couldn't deal with the building. And it took me a while to figure this out because I didn't know any better. Now, a mentor would have said, hey, Michael, you probably should put someone in there that knows Section 8. Kind of like if you buy student housing property, nothing wrong with that, but you should put a property manager in place that is that knows student housing. Same thing for the Section 8. So finally, I realized my mistake and found someone who was very familiar with managing Section 8 buildings in this area. And everything very changed, and we were able to get rid of the tenant amicably and actually stabilize the property. The problem until then, I lost so much time. Took me about 18 months. And I depleted my construction budget so I could really actually never complete what I wanted to do. I almost ran out of money, just frankly couldn't operate the building anymore. Now, luckily, the marketing in DC has appreciated in that time, and it kind of erased my mistakes I made. My point is, well, one point is following. Don't try to do this on your own, because you're going to make a lot of mistakes and lose a lot of time. And the opportunity cost is very big in doing that and losing time. But more importantly, in hindsight, had I been working with someone a little bit more experienced, they probably would have, well, aside from talking me out of doing in DC, probably would have pushed me into doing a larger deal. So it's not just the mistakes you make and the money and the time you lose, but it's also the opportunity cost of not doing bigger deals faster. Now, my point I'm trying to get to is, after 18 months, this property kind of stabilized. All right. In Section 8, one advantage of it is it does pay on time. And in DC's case, it actually paid above market, which was valuable. So once we get all these things stabilized, this property actually started making money. And it started sending me $1,500 a month in mailbox money. At that point, I got a little bit bored, and kind of went back to my flipping business. It didn't luckily last that long until I was bored, because finally a light bulb came off. It went off. And it's because of what I said earlier today, that the flipping was really a lot of work. And I was like, man, I just created a rat race, a hamster wheel for myself. Yes, it was real estate investing. And yes, I was doing it full time, but a hamster wheel nonetheless. And if you got out of it, then the money would stop flowing. And I saw this apartment building, there's no way a rental would have generated $1,500 a month. In hindsight, buying this building was a little bit more effort than buying a house, frankly, because you still need to have inspections done. You still have an inspector there. You had a GC walkthrough. You had to do a bunch of work, and the GC does all the work. So at the end of the day, it really wasn't that much more work. And I was like, I just bought 12 houses essentially with one transaction. And this is now sending me $1,500, right? Theoretically, if I get another 10 of these, then I could get to my $10,000 per month, right? So around 100 units, I guess I was figuring. And so that's kind of when the light bulb went off. And in hindsight now, when I'm looking at all these strategies, I talk to people all the time. And I love talking to people who want to scale their real estate investing. This lights me up, right? Because I have something to say about the matter. I have something to say about scaling with real estate. And the vast majority of people believe that they can scale their real estate with rentals or flips or STRs or whatever the case may be. And maybe, but at what cost and what effort? And there's 3 criteria I want to talk to you about today. When you look at your strategy and what you are currently doing and what you're thinking of doing, put it through this filter. There's just in a business opportunity, anything, and I'm including franchises or buying businesses or really whatever else is popular at the moment. People are trying to get financial freedom through a variety of different things. There's 3 filters I want you to use in evaluating whatever biz op or real estate strategy that you're thinking of. And the first one is scalability. Okay, scalability. And that is like literally from a numbers perspective. Can I scale this thing? Is it worth my while? Right? We talked about flipping and rentals. Flipping is worthwhile. You can make $25,000 to $50,000 a flip, but the problem is it's very difficult to do without working harder. And I want something when it's scalable. I want the numbers to be big, but I want to be able to make those numbers bigger without having to work harder. Okay, so I need some kind of leveraged opportunity. I don't think there's no such thing as purely passive income unless maybe you're getting interest and dividends possibly. Okay, but what I am looking for is highly leveraged activity. I want to know that for every hour I spend working, I want to produce X amount of dollars behind. I don't want to trade time for money. And also, when I stop working, I want to I want that money to keep flowing even while I'm sleeping. So I want this to be scalable, but not at the expense of passivity or leverage time. So I need it to be scalable and passive. So look at these activities that you're doing from a lens of both. Are the numbers attractive? And can I make those numbers bigger without working harder? And the answer for flips and rentals was no. I can make the numbers bigger, but I have to work harder. And the only people I see becoming, quote, successful at this is people who ground through and built that 50-unit housing portfolio. And it was a god-awful amount of work until they got big enough to actually hire a team around them. But the effort and the time it takes to get to that it's too much work, and it takes too much time. Versus in apartment buildings. Okay, apartment buildings, for the reasons I mentioned earlier, are much, much different. Because the units are bigger, the revenue is higher. You also have a professional property manager that's built into the model. Again, with single family rentals, it's typically not, which is why so many landlords self-manage their portfolios, because they really have no other choice. And so with multifamily, it's very unusual for someone to self-manage their building, unless the building is smaller, or unless the portfolio is much bigger, like 1,000 plus. Then it starts making a lot more money, more sense, because of the management fees to actually do it yourself, and you get some benefits of that. But it's a pretty big decision because it's a very complex, human-intensive business. And the only buildings you see self-managed are in the smaller end of the scale, so 10, 15 units, that kind of stuff. If you're more in the middle, like 25 plus, they're almost always professionally managed, and the result is almost always better because you have a professional management company with accounting and maintenance and things like that. They have systems in place and people in place to handle the things that would take you hours and hours of time. And so it's much better. So that what this means for investing purposes, if it takes, let's say it takes time to buy an apartment building, and let's say it takes, I'll make it up, double as much time as a house. Okay, it's generous, but let's say it does. Okay, so it takes some time to buy an apartment building, and yes, we got to talk about raising money. We're not going to do that on this show. Okay, but my point is, you can then buy a building, put a professional management team in place, and then do it again. Okay, and every time I do it, I'm handing off the building to my property manager. So I don't have to work more. Now the property management company has to work more. They have to hire more people, and now they have a lot more overhead. The only thing I have to do on my end is I have to oversee the manager. That's called asset management. And the difference between asset managing, one property and 10 property, you can asset manage one property with, I don't know, an hour a week, maybe a little more in the beginning, and then less once it stabilizes. So I'm just watching the reports and having conversations with the property manager. And then sometimes, yes, I do have to become more active and maybe have to replace the property manager. But again, I don't have to train the new person coming in. I just simply hand the keys to the next property management company. They're already trained. Like, for example, with the franchise, the restaurant franchise I did hire a guy to run all the franchises. Okay. But at one point, and then what if that person leaves? Or what if you have to fire that person? In my case, I had to let the person go because of the recession. I couldn't afford them anymore. Either way, now I'm running 6 restaurants. So my little, passive investing thing that cost me a week or two to manage, me meeting with my operator, looking at the numbers and patting myself on the back, now turned into a 60-hour per week job because I'm driving 1 hour one way to manage these 6 restaurants. And so what I believed to be was a passive investment, it was now the exact opposite. It was an actual nightmare. So think about the succession strategy, if whatever business you're working in, how readily available is a manager of that business. And this is really why I like multifamily, because a property manager is the manager is already built in. Replacing that manager is relatively easy. I don't have to recruit some CEO, a highly paid CEO. I don't have to get that person up to speed and train that person for 3 to 6 months. I simply find a highly qualified property manager and hand off the keys. So what I'm saying to you is the thing I like about multifamily is that the numbers are interesting to me, right? That they're big, and I can build a portfolio without working harder. So it really checks both of those 2 boxes. Now, the numbers are big, obviously, because there's more units involved. But one of the things you may or may not know about it, one of the reasons it's so big is because of the acquisition fee. In general, the profit centers of a multifamily syndication are quite a bit different than on a single family house, right? So the acquisition fee is typically 3% of the purchase price, and that is paid at closing when you buy. That's unusual. There's no single family house strategy that pays you when you buy, unless you're maybe the broker on the deal. But with multifamilies, it's typically 2 to 3%. 3% of a $4 million deal is $120,000. That's a big deal. This is one of the main reasons that people who get into this business are able to quit their job within 1 or 2 or possibly at 3 deals because of the acquisition fee. Right, it's a pretty big deal, and this is why this is just such a strong vehicle to get you out of whatever you're doing right now is the acquisition fee. But it doesn't stop there, because as a general partner, you're also getting fees. Typically, they're asset management fees that you're getting, but you're also getting sweat equity in the deal, so you're getting cash flow and profits at the end. So it's very lucrative business. And because you're not just buying 1 10-unit every single year, if you're gonna start a 10-unit, let's say, then the next one is probably going to be around 25. And if you can do a 25 unit deal, that's going to be a 50 unit. And if you can do a 50 unit deal, well, at that point, it's 100 plus, right? So in other words, they're not linear. It's not like I have to get 50 units, I have to buy 50 houses. To get the 50 units, I might have to buy 1 or 2 deals. And so it's a lot less effort to get to that from a transactional perspective. So scalability and passivity is very important. And there's a third component, and that is risk. Risk. Now, when I quit my job and got in the restaurant business, I had no concept of risk. And the reason I proof of this is that I was signing leases, and they're all personally guaranteed. What does that mean if you personally guarantee a loan or lease or anything? That means if something goes bad and you owe money, they're going to sue you, and they're going to win, and they get to go outside the LLC, or whatever assets are there, which in this case there will be none, and they can go to other assets. They can go to your personal assets, your house, your car, your pets, your child, okay? And this is bad. And so I did not realize 2 things. One, what that really meant when I signed these docs, and I should have probably negotiated them down in some way, but that would have required me to think about, B, the downside, which I didn't. And so I got into these restaurants in 2006. By the time 2008 rolled around, I had, at that point, I think about 3 or 4 restaurants. And the recession really knocked the concept back. It was a high-end gourmet pizza concept, and it went gangbusters, because in 2005 and 6, the economy was really strong. If you remember, the real estate market was in the stratosphere. People were making money, and it was awesome. And people were spending money also, especially on high-end gourmet pizza. Even to this day, this pizza, I think, is still the best pizza in the world. But back then, no one wants to spend $25 for pepperoni pizza, which is what it costs. I don't care how organic it is. Once the recession hit, everybody wanted to pay no more than $9.99 for 3 toppings and a coupon for 50% off for the next visit. That was the environment we were in. So what happens? The revenue were shot down by 25%, which put me immediately at break even. And it was a downward spiral from that point forward. And so there was this component of risk. There was this thing that I spent literally millions of dollars on and years of my life. And all of a sudden, poof, it's gone. It's worse than gone. It turns into a complete nightmare. Same thing for single family houses, right? You remember what happened in 2008. There's people I know who over a 5-year period built up sizable rental portfolios and were really crushing it. Now, yes, could you say that they were maybe a little aggressive? Were they borrowing too much because lenders gave them too much? Yes. Okay, fine. Perfect. But even if they had borrowed slightly less, they still would have been in a major problem. And so from a strategy perspective, I don't want to invest the next 5+ years of my life building, quote, wealth, and then all of a sudden something happens outside my control that makes it go away. That's bad. Another great example is short-term rentals. Short-term rentals, I remember, my gosh, 7 years ago, whatever, this was the coolest thing. And I thought for a second, you know what, I want to put short-term rentals equivalent to multifamily, because I knew people that could literally make like $1,500, $2,000 per month profit on a short-term rental. I was like, this is awesome. And in fact, one of them I know, they had 3 rentals and quit their job, and he was a highly paid engineer. I was like, man, this is pretty powerful. I got to say, I used to say multifamily is the only way to do it with real estate. And I was like, maybe there's a second way to do it. But that has significantly changed. I have another friend of mine who, over the last 7 years, built up a very sizable short-term rental portfolio of a couple dozen. And 3 years ago, he was reporting a significant decline in income. A year later, he was like, man, I got like 70% of my portfolio is in the red. And he had it in different places. It wasn't just one market. It was in multiple markets, one in particular, but the effect was felt all over. This was all after COVID. The reason he explained to me is that because you're making so much money with real estate, so much more than a long-term rental, a lot of people got in the business. Well, I can do this, right? I can do this. And they got into the STR market, and it brought in all these people. And of course, what happens when the supply goes up and the demand is basically static? Well, the rents are going to go down. So he started going into red. And so now he has started to, he's been trying to sell for over a year now, but the problem is selling in this environment is very difficult because the interest rates are so high and the housing cost is so high. And so he's had really a difficult time getting his money out of these STRs. So an example of something that had a limited runway. Another thing that I really like right now is these pad splits, right? These co-living things. I mean, anytime you change the use of something like a rental property and you use it in a different way that makes more money, I like that. The problem with the pad splits right now is that they're so new. They're like Uber was 10 years ago. There's no legislation, and so they say don't buy these pad splits or these co-living in an HOA because they'll probably disallow it. But a lot of jurisdictions are now disallowing it in certain zip codes as well. Well, what happens if you buy one or two of these pad splits, and now legislation is passed that basically forbids this kind of cohabitation? Now you bought this thing, you maybe even paid more for it, and now you can't get the income you wanted, and now the business opportunity is dead. So there's a lot of risk involved in these strategies. And I truly believe that we're not in a risk avoidance business. If you're an entrepreneur, you're not in the risk avoidance business. It's impossible. But we are in the risk management business. And this is what I'm talking about right now, is you really want to manage, you want to know your risk. And if you know your risk, you can manage it. And a lot of times that makes an acceptable thing to do. So in what you're doing right now, make sure that that you have runway. Like I said, I don't want to do something for 5 years and then something out of my control happens that makes it go away, and that could be a recession. Okay, so how recession-proof is your strategy? But it could also be legislation, right? Like we saw in Airbnbs when they banned it in New York City. Holy cow. How many investors lost their shirt when that legislation was passed? Completely out of their control. So what is your runway on this thing? Because if I'm going to do something, I'm going to do it, and I'm going to do it for 5 years, and I want to build wealth. That's what I want. And I don't want it to go away unless there's some black swan event, like a meteor hits the earth or something like that. I want to make educated guesses. And for those reasons is why I like multifamily, because the numbers are bigger and I can grow those numbers with less effort. And I believe we have decades plus runway. Why do I say that? Because first of all, if I look back at how multifamily has performed over 50 years, yes, it has its ups and downs, but the defaults that have happened have been very, very low. The worst probably real estate recession we ever had was probably in 2008, well, at least in modern history, and it decimated the single family house market. Now, it definitely hurt the multifamily market, but it did not decimate the market. In other words, the defaults were for government-backed loans was only 0.4% of all government-backed loans, versus it was 4, depending on which report you read, 4 to 5% on similar government-backed, these are Fannie and Freddie loans, 4 to 5%. So it's a staggering difference in the default rate. And the reason is because the risk is lower on a multifamily building because you have multiple tenants, right? If a building goes into negative territory, let's say it's 100 units, you'd have to go below 65 tenants for that thing to go negative in a lot of the cases. So the break-even point is very low for multifamily. So what happened in 2008 is that, yes, rents were down, maybe occupancy was down a little bit, but they were still far above the break-even point, so they're still cash flowing. Now, should they have refinanced or sold in that time? Well, no, but they could ride it out. And so I like the way it performed going back in time, which makes this one of the more recession-resistant strategies. And I also like the way it behaved in COVID, for example, and even in the high interest rate environment. If you look at the high interest rate environment, if you have a fixed interest loan, is it a good time to buy, a good time to sell or refinance? No, it's a bad time to refinance or sell, but I can ride it out. And that's exactly what's happening right now. So I like that. I also like the outlook for multifamily. What I mean by that is that the affordable rent, there's no more affordable housing that's built. When I say affordable, I'm not talking about subsidized or Section 8. I'm talking about affordable as in it doesn't cost $3,000 in rent. I'm talking it costs between $1,000 and say $2,000 is what I consider affordable housing, because the average mortgage rate is significantly higher than that. So affordable rental property. Now, in our country, depending again which report you read, we're between 3 and 5 million housing units short. Let's go with 3 million. It's still a big number. And there's really no solution to it. And why is that? It's because the cost of construction has skyrocketed, first of all, because of inflation, number one. Now the high cost of capital, interest, number two. And now we have unknown tariffs thrown on top of it. So the cost of construction is so high that developers have essentially stopped pulling permits. So if you look at the apartment permits, they're down like 75% over the last 18 months because developers can't make money anymore. And if they do develop something, it's got to be luxury Class A. It's the only way to make money. Therefore, no one's building Class B and C housing anymore. Now, I know this is age, Class B is age, etc. But I'm talking about from an affordability perspective. No one's going to build an apartment building and charge $1,500. certainly not in Atlanta, maybe some in the middle of nowhere. So what I'm saying is there's no solution to the affordable housing problem yet. The population is growing, or people are migrating into warmer areas, whatever the case may be. Population is increasing and the housing stock is not. What is that going to do to the rents, right? It's going to drive them up, right? And what will happen is it'll create an affordability crisis, which we already have, which is bad for Americans. There's no question about it, right? If I'm used to living in Class B, the rents go up and I can no longer afford Class B. Where am I going to go? I got to go to Class C, right? Or I have to get a smaller unit. And so this is bad for Americans. But if you own real estate, it's actually good. And I don't, it's just free market forces that you could and should take advantage of. Yeah, should you do the best job of providing quality housing versus being a slumlord? Yes, you should. But this is what's happening longer term in the multifamily space, and there is no end in sight unless something magical happens. I don't know. The government could print money and provide subsidies, and that's great, but that's going to create inflation, and we already know what happened with that. So I like the long-term outlook of multifamily. So you put everything together and you take those three lenses of scalability and passivity, and then the risk. And the risk is twofold. One, it's really, what is the runway you have? At the end of the day, risk is, what is the runway you have? Can you spend 5 years and really build wealth in whatever strategy you're thinking of doing or maybe have done in the past? And if not, then maybe you should reconsider and pivot your strategy. So those are the reasons I really like multifamily. Now, you're probably wondering, well, okay, Michael, isn't multifamily a kind of an advanced strategy? And it sounds like it is, but the truth is it's not. And the reason it's not is that you don't actually need 5 to 10 years of real estate investing experience to, quote, graduate to apartments. You can actually do it right now. If you've done a deal or two, fantastic. It's not required, but it certainly helps. And you don't need to save your way to real estate. A lot of people are trying to save and use a HELOC, and then they're buying a house or a rental, and maybe they're buying one the next year or 2 years afterwards. You don't have to do that either, because you can learn how to raise money. Literally within 30 days, you know how to raise money, and you're starting to talk to investors. And in 60 days, you start developing a very high degree of confidence. I know that because we work with students all the time, and zero of them have ever raised money before. And then all of a sudden, they're raising $500,000, $600,000. Scott Todd recently did his first raise, and it was $800,000. And another business partners, Ryan and Russ, raised 2.1 on their first raise, right? So these are people who have W-2 jobs, or maybe they're business owners and they've never raised money before. They're like, oh, I can't raise money. I don't want to raise money. And yet they somehow do. So somehow it must be possible. What I'm telling you right now is you can raise money to buy real estate. And if you can raise money to buy real estate, you can buy more real estate. Now, I'm not going to talk about today because we talk about raising capital and building up experience and things of that nature in other podcast episodes. But for now, if you want to learn more about that thing, about apartments and kind of how syndications work, then go to thefreedompodcast.com, thefreedompodcast.com. There's several resources on that. The idea with this site is to kind of give you a next step into the wonderful world of multifamily syndication. So on thefreedompodcast.com, there's something on there called Apartments 101, and it's a 45-minute training that introduces you to the world of multifamily syndications, kind of how they work, and things of that nature. Also, if you are ready to kind of get going and start scaling, but you really don't know how to do it right now, on that page also you'll have an ability to book a call with us and explore what it's like to work with us. So either way, either if you're just gathering it, and then also, of course, we have this podcast, we have a YouTube channel, blog post. If you're simply in the information collecting stage, then check that out and then make up your own mind. So hopefully I'll try to sway you a little bit on what your current path is. Want to help you get to that goal, financial freedom, as quickly as possible. And hopefully you have found this helpful. Catch you next time. So if you want to learn more about apartments and how you can overcome this lack of experience and how to raise capital and things of that nature, then check out my Apartments 101 Masterclass, because it covers all those things, gives you a great introduction into syndications and how to do the things that we just talked about here, how to get experience, how to build your team, even how to find those deals and how to raise capital. So check that out. The best way, the next best step here from the podcast is go to thefreedompodcast.com. That's kind of your next step. So you'll find Apartments 101 on that. It's thefreedompodcast.com. And on that page also, if you want to book a call and explore working with us, that's a great way to do that. If you're more of a passive investor, also go to thefreedompodcast.com if you want to learn more about real estate syndications and what it takes to invest passively in them. There's also a mini course on that as well that you can find. And again, if you're interested in finding out more or connecting with us about investing in our deals, then check us out on nighthawkequity.com. All those links are on the freedompodcast.com. Sorry, that's the next step here. I don't want to confuse you. So the next step, whether you want to become a general partner or limited partner, is the freedompodcast.com. So hopefully that'll provide you with some next steps, and then I'll talk to you on the next episode.